When I look at what's happening around the world today, one thing is clear. Depending on a single currency has become one of the most underestimated risks of our time. For decades, people trusted one dominant financial system, one central authority, one currency that represented safety and stability. But as innovation accelerates and borders blur, the definition of safety is shifting. The assumption that one currency, controlled by one nation or one institution, can represent long-term security is being quietly rewritten by technology, decentralization, and a new generation of investors who understand that the future won't be built on singular dependence. It will be built on diversity, adaptability, and resilience. Currencies, like empires, rise and fall. They reflect the trust of their time. History reminds us that the pound once ruled global trade, then the dollar. Each seemed invincible, until technology, policy, and human progress reshaped the global landscape. What we're witnessing now is another transition point, one accelerated by innovation itself. The rise of digital assets, decentralized networks, and new forms of programmable money are not temporary fads. They are signals that the world is diversifying its financial DNA. This isn't rebellion, it's evolution. When you rely on a single currency, you are effectively placing your faith in the policies of one government, the integrity of one system, and the sustainability of one economic engine. That concentration of risk may not be visible day to day, but it's real. Inflation, fiscal mismanagement, or even political uncertainty can erode purchasing power faster than most expect. Meanwhile, those who diversify across assets, regions, and technologies protect themselves from being at the mercy of any one economic story. The goal isn't to abandon a system, but to acknowledge that no system is permanent. Innovation does not respect old boundaries. Blockchain technology, digital wallets, and tokenized assets are reshaping how people store, transfer, and grow value. We now live in an era where an investor in Asia can hold assets in a US stablecoin, own fractional shares of global companies, participate in decentralized finance, or even back early-stage technologies without touching a traditional bank. That's a revolution. It's the democratization of money itself. Relying on one currency in this environment feels like relying on one stream in a world of rivers. Diversification today isn't just a financial concept, it's a survival strategy. Think of it as insurance against concentrated uncertainty. The future economy will likely be multi-layered: national currencies, digital assets, central bank digital currencies, and decentralized protocols all coexisting. Each will serve a different purpose, but together they'll represent a more resilient global financial system, one not dependent on a single point of failure. The market rewards those who anticipate this shift, not those who resist it. But it's not only about currencies, it's about mindset. Relying on one currency also means relying on one narrative, the belief that what worked yesterday will continue to work tomorrow. That belief has failed investors time and time again. The real opportunity lies in understanding that innovation compounds faster than monetary policy can adapt. That's why exposure to transformative technologies, artificial intelligence, energy storage, robotics, genomics, and decentralized finance isn't speculation, it's preparation. Throughout history, the most successful investors weren't those who reacted to change. They were those who positioned before it became obvious. The early believers in Bitcoin weren't just chasing a price movement, they were challenging the monopoly of centralized trust. Today, similar opportunities are emerging in areas that combine technology and finance in unprecedented ways. The key is not to fear change but to see its structure, its logic, and its inevitability. The next decade will reward clarity of vision over comfort of tradition. Nations will compete not just over resources, but over who controls digital infrastructure, data, and financial access. As power shifts, currency dominance will shift with it. But the individual investor today has more tools, more access, and more autonomy than ever before in history. You don't need to rely on one government or one institution to protect your wealth. You can build your own ecosystem of value, globally diversified and technologically secured. What we're really talking about is independence. True financial independence doesn't come from trusting a system. It comes from understanding it and knowing when it's time to evolve beyond it. The future of wealth is borderless, digital, and adaptive. It's not about replacing one currency with another. It's about creating a framework where no single currency can dictate your financial destiny. So as we move into this next phase of global innovation, remember, security doesn't come from standing still. It comes from positioning where growth is headed, from aligning your assets with technologies that redefine efficiency, and from having the courage to think beyond what's familiar. Don't rely on one currency, because the future won't. The next great transformation in wealth won't be about what currency you hold. It'll be about how you think. In times of rapid change, clarity often hides beneath noise. We're living through one of the greatest transitions in financial history, one where value is becoming increasingly abstract, digital, and detached from tangible foundations. But every major shift, no matter how technological, always circles back to a simple truth: own real things. Real value endures. It survives currency debasement, political cycles, and algorithmic trading. It withstands what paper promises cannot. Real things, productive assets, innovation-driven companies, scarce resources, and technologies solving real-world problems, hold intrinsic worth that transcends speculation. They create, they generate, they multiply. They are the anchors in a world of floating narratives. Too many investors today are chasing illusions. Numbers on screens, tokens without utility, trends that echo sentiment rather than substance. But innovation is not illusion. Real innovation produces measurable impact, energy efficiency, computational breakthroughs, disease eradication, and new economic frameworks. These are not theoretical, they are transformational. And when you invest in them, you're not just holding an asset, you're owning a piece of progress. Owning real things doesn't mean rejecting the digital era. It means understanding which parts of the digital world are built on solid ground. Artificial intelligence, robotics, genomics, and next-generation energy solutions aren't speculative abstractions. They're tangible innovations reshaping production, healthcare, and infrastructure. Each breakthrough compounds on another, driving exponential productivity growth. Those who own stakes in these transformations don't just profit, they participate in the foundation of the next economy. Value today is too often confused with price. Price fluctuates with emotion, but value compounds with innovation. When markets panic, prices fall, but when technology advances, value accumulates quietly beneath the surface, waiting for recognition. Owning real things means aligning yourself with that underlying progress rather than the crowd's reaction to it. It's a mindset rooted in conviction, not convenience. We've seen this play out before. Investors who owned physical assets during inflationary decades preserved wealth, while others watched purchasing power erode. Those who owned stakes in the early technology revolution turned volatility into opportunity. Even in the early days of digital finance, those who understood that software and networks were real productive assets, not mere trends, built generational fortunes. History consistently rewards those who see through illusion and recognize substance. But in every cycle, markets tempt us to forget. Speculative manias whisper that this time is different, that fundamentals don't matter, that something purely digital can grow infinitely. Yet every bubble eventually reveals the same truth: capital must flow to things that create, serve, or solve. The world's greatest fortunes were never made by trading symbols. They were made by building, owning, and holding real things, ideas turned into reality through persistence and vision. In a world of financial engineering and synthetic exposure, owning real things is also a form of protection. It's protection against inflation, currency manipulation, and systemic uncertainty. Real assets, whether tangible or technological, don't vanish when confidence fades. They continue to produce output, data, and value. They survive what speculation cannot. This principle extends beyond commodities or real estate. The most valuable, real things today are the innovations that are redefining what productivity means. A company developing autonomous logistics systems, a lab sequencing genomes at exponential speed, a platform decentralizing financial access. These are the factories of the future. They're not physical in the old sense, but they're real in every economic sense. They create efficiency, generate data, and accelerate human progress. Owning real things also builds emotional resilience. When you understand what you own and why it matters, you stop reacting to headlines. Volatility becomes noise instead of threat. You move from speculation to conviction. That's the difference between chasing returns and compounding wealth. Ownership of substance allows investors to think in years, not minutes. It cultivates patience, the rarest and most powerful asset of all. And it's not just about wealth preservation. It's about participating in value creation. When you own real things, you align yourself with human ingenuity. You become a stakeholder in the future, not a spectator of it. Every disruptive leap, whether it's cleaner energy, intelligent automation, or medical breakthroughs, represents a transfer of value from inefficiency to innovation. The investors who identify and hold those catalysts early are the ones who define tomorrow's economy. We're entering a decade where illusions will fade, leverage will unwind, and truth will matter again. Digital noise will give way to digital infrastructure. Artificial narratives will collapse, leaving behind only the assets with genuine productivity. That is where long-term capital will flow, and that is where wealth will endure. Owning real things isn't a defensive strategy, it's an offensive one. It's a vote for progress, for substance over speculation, for innovation over imitation. As the world digitizes everything, scarcity shifts from physical goods to authentic creation. The scarcest asset in the coming age won't be gold or data, it will be truth, and real things, whether physical or intellectual, embody that truth. So as the world races toward abstraction, remember what endures. Own what builds, what scales, what creates measurable impact. Because when the next cycle of noise fades, and it always does, only those anchored in real value will remain standing. Own real things. The future belongs to those who do. In investing, the most dangerous belief is certainty. The conviction that one idea, one asset, or one trend will carry you safely through every cycle has broken more portfolios than any bear market. True protection doesn't come from hiding, it comes from understanding risk, and diversification is the most intelligent form of protection there is. Not the kind that scatters capital randomly, but the kind that's built through thoughtful exposure to innovation, growth, and structural change. Diversification is not about fear, it's about balance. It's about acknowledging that no single asset, no matter how strong, can dominate forever. History has taught us this repeatedly. Every major trend, whether in energy, technology, or currency, has its season. Those who survived and prospered weren't those who guessed the next winner perfectly, but those who positioned across multiple fronts of innovation, capturing the upside of new paradigms while softening the blows of the old ones fading away. In times of disruption, correlations shift. Assets once considered safe begin to lose purchasing power. Inflation erodes the value of cash. Monetary tightening punishes over-leveraged positions. Geopolitical realignments reshape supply chains and valuations. In these moments, diversification reveals its strength. It's the ability to stand firm when others are forced to sell. It's the discipline of being exposed to ideas that move independently of each other, where weakness in one area is offset by growth in another. But diversification in this new era looks different from what textbooks describe. It's no longer just about splitting capital between stocks, bonds, and commodities. That framework was designed for an economy that changed slowly. Today, innovation cycles move at exponential speed. Technologies converge, industries dissolve, and entirely new markets appear almost overnight. Diversification now must include exposure to the transformative forces shaping the future: artificial intelligence, autonomous systems, blockchain, genomic medicine, and clean energy. These are not speculative bubbles, they're foundational technologies redefining productivity across every sector. The key is to diversify across time horizons and transformation curves. Some innovations are already scaling, others are just beginning. Some may fail, but those that succeed can offset multiple losses. That's the essence of asymmetric reward. One breakthrough can redefine an entire portfolio. Diversification doesn't mean diluting conviction, it means protecting conviction through structure. You can hold strong beliefs about the future and still hedge intelligently against uncertainty. Many investors mistake concentration for confidence. They equate focus with strength. But confidence without diversification is fragility disguised as conviction. Real confidence comes from knowing that even if one thesis underperforms, your broader framework remains intact. The future rarely unfolds linearly. Sometimes innovation accelerates faster than expected, sometimes it pauses. The investors who endure are those prepared for both outcomes. In a world of rising volatility, diversification also protects psychology. It keeps you rational when markets are irrational. When one position falls sharply, another may rise. That balance prevents emotion from taking control. It allows you to hold long-term positions through cycles of doubt. Because investing is not just a test of analysis, it's a test of temperament. Diversification builds the emotional resilience required to stay invested when volatility peaks. And yet, diversification isn't about owning everything. It's about owning enough of what matters. It's about identifying uncorrelated sources of growth, industries and technologies driven by different economic forces. For instance, energy transformation doesn't move in sync with artificial intelligence, and healthcare innovation doesn't correlate perfectly with blockchain adoption. By combining these, you create an ecosystem of exposure that thrives in multiple scenarios. That's how portfolios become antifragile. They benefit not only from stability but from disruption itself. We are living through a convergence period where innovation across fields is compounding. AI is accelerating data analysis for genomics. Decentralized finance is enabling capital flow into new energy and tech ventures. These crosscurrents make single-bet strategies increasingly obsolete. The future belongs to those who understand how interconnected progress has become, and who diversify across those intersections. There's also a deeper philosophical truth here. Diversification reflects humility. It acknowledges that even the best research can't predict timing perfectly. It's a recognition that markets evolve faster than any single thesis can capture. Humility is not weakness, it's wisdom. It says, I believe in transformation, but I also respect uncertainty. That respect is what keeps investors from being wiped out by confidence taken too far. In the coming decade, volatility will be the price of progress. Innovation will challenge every legacy model, and traditional hedges may not behave as expected. Bonds may no longer protect equities. Fiat may not protect purchasing power. Only genuine diversification across geographies, asset types, and technological revolutions will offer stability through change. It's not about running from risk, it's about aligning with reality. Protection doesn't mean stillness. It means adaptability. It means constructing portfolios that breathe with the market, not fight against it. It means holding positions that benefit from different outcomes, growth, contraction, inflation, or innovation, because the world doesn't move in straight lines anymore, it moves in exponential curves. So when I say diversification is protection, I mean it as both strategy and mindset. It's protection not only for capital, but for conviction. It's the structure that allows you to stay optimistic when others panic. It's how you participate in the upside of transformation without being destroyed by its volatility. The goal isn't to predict the future, it's to stay alive long enough to participate in it fully. That is the quiet power of diversification. It doesn't shout, it doesn't chase, it endures, and in a world changing faster than any before it, endurance may be the most valuable asset of all. Every major transformation in history has followed a cycle, periods of euphoria, disruption, disbelief, and eventual acceptance. The challenge is that most people only see the moment they're in, not the broader rhythm that defines it. Thinking in long-term cycles requires stepping back far enough to see how innovation, economics, and human behavior interact over decades, not days. It means understanding that progress rarely happens in a straight line. It moves through phases of acceleration and reset, creation and correction. And those who learn to think this way don't just survive volatility, they harness it. Right now, we're in the middle of overlapping cycles, technological, financial, and demographic, all converging to reshape global systems. Artificial intelligence, energy storage, robotics, and genomics are not isolated trends. They are the next great wave of productivity, but like every cycle before them, their adoption won't be linear. There will be hype, fear, pullbacks, and breakthroughs. The investors who understand this rhythm, who look beyond short-term noise will find themselves aligned with the deepest currents of long-term growth. Short-term thinking is the enemy of exponential opportunity. Markets are driven by emotion in the moment, fear, greed, and reaction. Long-term cycles, however, are driven by mathematics and innovation. The human mind tends to overestimate what can change in a year and underestimate what can change in a decade. That's why true exponential returns are only visible to those willing to look through temporary volatility and see the compounding forces beneath. Consider what happened with the internet. In its early days, valuations exploded and then collapsed, leading many to believe the entire sector was over. Yet those who recognized the long-term cycle, the migration of information, commerce, and communication, didn't just recover, they built generational wealth. The same pattern is playing out again, only faster. AI, blockchain, autonomous mobility, and synthetic biology are all following similar curves. The short-term volatility disguises the underlying exponential trajectory. Long-term cycles are not just about innovation, they're also about psychology. Every major shift starts with skepticism. The crowd dismisses it as a fad, then gradually accepts it, and finally overcommits when it's already priced in. By the time the masses join, the cycle is mature. The goal is not to follow sentiment but to anticipate its rotation. Thinking long-term means positioning when conviction is scarce and harvesting when optimism is excessive. The economy itself moves in cycles that often mirror technological adoption. Productivity rises when innovation scales, plateaus when it matures, and then reignites when the next breakthrough arrives. Today we are entering a phase of renewal. After decades of incremental growth, we're witnessing the beginning of multiple exponential technologies converging at once. This doesn't just reset industries, it resets entire economic models. Those who mistake short-term turbulence for decline will miss the expansion phase that follows. Long-term thinking also requires emotional discipline. It's easy to be patient in theory, but difficult when prices swing sharply and headlines amplify fear. Yet, if you zoom out far enough, every correction in history looks like a small deviation on an upward slope of progress. Innovation doesn't move backward, it compounds forward. And capital follows innovation. The investors who internalize that truth see volatility not as risk, but as opportunity to accumulate at a discount before the next cycle unfolds. The world tends to reward the impatient in the short run and the patient in the long run. That's why long-term thinkers often look contrarian. They invest in areas where the data is young, where the models are still evolving, where the future is uncertain. But that uncertainty is precisely what creates asymmetry, the potential for disproportionate upside. When others see risk, long-term thinkers see mispriced possibility. Cycles also teach humility. Every boom creates overconfidence, every correction restores perspective. But for those who stay focused on fundamentals, on real adoption, cost declines, and productivity growth, the long-term pattern remains intact. Innovation compresses cost curves, expands access, and accelerates efficiency. These are the structural forces that drive multi-decade wealth creation. The key is to remain aligned with those forces even when the market temporarily forgets them. Patience is not passive, it's strategic. It's the willingness to hold conviction through noise because you understand the destination. Thinking long-term doesn't mean ignoring change, it means recognizing its tempo. Every innovation starts slow, hits resistance, then scales beyond imagination. The greatest fortunes are built not by predicting the next headline, but by identifying the next S-curve of growth and holding it through its full arc. We are living through one of the most profound transformations in human history. Energy, data biology, and intelligence are converging into a new economic structure. The short term will be noisy, chaotic, and uncertain, but the long term is remarkably clear. The world is becoming more efficient, more interconnected, and more intelligent. Each wave of volatility simply clears the path for the next phase of compounding. So think in decades, not quarters. Anchor your strategy to innovation, not emotion. Build conviction where others see confusion, because history rewards those who understand that cycles don't end, they evolve. The future doesn't move in straight lines, it moves in waves. And if you can learn to ride those waves, to think in long-term cycles, you won't just witness transformation, you'll be part of it.